Hello, investor. Hopefully, you are having a wonderful time. Today, I'm covering the RIOCAN. This is a REIT stock, the ticker and the Canadian REIT. This ticker is REI.UN.TO. Myself, Pramod Kumar. I'm a CFA charter holder and FRM certified. This REIT is requested by the YouTuber Gangsterly, and that's one of the reason I'm making this video. So thank you for giving the opportunity to me to analyze this stock. So this is the agenda, quite deep, and if you can see quickly, the market cap for this REIT is $4.5 billion, right? As and all this analysis is based on very recent financial statements. So they just have released their quarterly third quarter report, right, of 2020. So very latest information to see, uh, and this is a very good dividend paying stocks. So the two reasons, another reason what I like about this is from the right now is this one. So the price over book is only 58. So this means this is heavily discounted stocks, right? Over, so 42%, almost 42% discount from its original price. It's giving the earning per share is right now as 0.27. The enterprise value, when I checked, it is around 11.2 billion dollars, right? So it has another good thing on this one, why somebody wants to invest in that is the real estate is pretty much good in Canada, and that it's paying the dividends, and the dividend yields right now is 10.014%, and the cherry on the top is this is monthly basis, right? So you will get this every month. You'll get, for share, you'll get a 12 Canadian cents, right? So that's very good. So if somebody wants to invest in it, but now the question is the company, based on the coronavirus, is the company able to sustain? Is the retailers paying it? Is the tenants paying the company, or what's the futures, right? So how the company financial and balance sheets look like? So all this we need to analyze and then makes the conclusion. Maybe the price uh, right now is already dropped, and so this is the chart, and if you can see here, the before the coronavirus split, the price was around here, right? Around this is 27.5, and this was a hit, right? So price came down around here 13 something, but so far the price come up, but then it went down again, right? So whether it's a downward trend, so I'm not here to do any technical analysis, but just want to see. So if you can see from here, it shows the red sign here, right? But this is another crisis. I have plot the 5-year graph. Just want to see overall from the price perspective also how the company is doing, just not focusing on the one aspect of the stock. Why? Because the total return, as you know, right, the total return is the price return, right? So what's the price? So if the price goes up, right, like this, that's good, right? So it comes from the price return, right? Plus if it has any dividend, right? Dividend, right? So if the company is paying the dividend, okay, that's good, right? So here we see the company's, let's assume round figure is 10%, but if the price decrease more, right, more than 10% here, right, let's say it's decrease 20%, the overall you are negative, right? If you want to sell your stock, then you are negative. So we need to keep in, so this is mine. So whenever somebody is just pitching the dividend, no, just take the overall perspective. There are so many the companies out there which is paying dividend, but we need to see from both perspectives. So I hope you'll get this idea. So now, so we see, but the good thing about here is, okay, with this, even the 2009, the crisis, the company basically grows, right? And then it has some dip, and then it grows, then it's dip, then it grows. But overall, if I can see, the company was somewhere here, and then if I see from the very, very long perspective, it grows, right? It looks here. And another good thing what I find it, so just by looking without even going into the financial, right? So the company, this is when I checked it, this is the dividend, right? So company consistently paying the dividend, but now the question is, can the company, because the main reasons people will buy the REITs because of the dividend, to get the money back, right, from its free cash flows. Otherwise people just go and invest, buy some kind of a property, physical assets and all, right? So let's get into detail without further detail, right? I think we have enough. So now the next question is, okay, the main one is the how what's the portfolio look like, right? So we'll go from the portfolio, then we go to the tenants, and then we see some financial, and then we'll go on to the risk, right, to make the complete analysis. Okay, so from this portfolio, this is their portfolio, right? So they have some retail space, and then they have very small office space, but major a part of there, which is the in the thousand, so 2034.247 million, which goes to the retail sector. So we'll focus more on the retail side, right, rather than on the office. If I see from their geographical diversification, their major, let's focus on here. So this is the 100%. So their major chunk is in GTA, right? So whoever downtown Toronto and all, which is very good, right? Okay, the properties is very expensive and is booming there. Next one is Ottawa. Even I like it. Ottawa is the capital of Canada. Major players there, partition player there, is pretty good. The third best is the Calgary. Calgary property is, I don't think so, is doing well because of the. I'm not very keen on that, but I'm not sure honestly. But I think the Calgary one is not that great. That's the 10% of their portfolio, and we have Vancouver is good, Edmonton and Montreal is okay, is small portion as well, but it's okay. Okay, so that's how their major portions of their properties. So let's see who are their major. The question is their major tenants, from the revenue is coming. So if I see from the first from the revenue diversification side, okay, the grocery is 64, excellent, right? Grocery, people always need a grocery like Walmart and all. I don't think so they are Walmart listed there. So grocery, Loblaws, okay, good. Sobeys, Shopper Drug Mart, Rexel, LCBO, Metro. Okay, these are all good name. Then we have this 6% is a restaurant, Tim Hortons, Canadian love Tim Hortons, right? Okay, McDonald's, kids love it. And juice and some other Subways is okay. So these are the restaurants are again there. So pretty big names, not a small names. So the good thing about this RIOCAN, even whenever I even go to their location, I always look at the Costco's, right? Costco, Dollarama, right, on the value table. So this looks like a big names, right? So that's very good on there. So on their side. But let's say they may be posting here only the big name. They have a small shop tenants as well. So maybe where they're having a challenges, right? Or maybe you never know. Like the big companies are also closing their stores. So the main problem, like for example, Cineplex, right? The movie theaters. This is 4.3%. How it affects their funds. So we'll see here in the next slides. But overall, I think it's not bad. Okay, so this is again their top 10 sources. I able to find it. So the top 10 are the Canadian Tire, right? So this is the major source of their income. Okay, very good. Loblaws, TJX companies, Cineplex. Okay, this is one negative, right? Metro, okay, Walmart, Montana, Swiss Chalet, and Kelsey's. I'm pretty neutral on this one, on the restaurant, honestly, now these days. Dollarama is good, Safeways, and again, this is pretty small, but still fitness. Pretty much the fitness is closed now, so they're losing here, and I'm not sure about, this is also 1.7% of the portfolio, right? Okay, and then Cineplex, this is the major one. It's pretty Okay, strange to see the Walmart only makes the 2.8% of their portfolio, where I don't recall, but I did a few months ago one another read. You can check out my channel. They have a heavy tenants. The major properties tenants is tenanted by the Walmart. So I think it's good to see now the comparison after seeing this. Okay, now see from the funds. Okay, how the REIT is valued, we don't see the they don't have like a gross profit and like another balance sheet. So we have to see from the funds from operations, because these funds and after it get paid out, right? So if I see from the so basically this is the how it's computed, and it shows as per their quarterly statement as mentioned. So this is the first 3 months, right? Sorry, this the 3 month added. So this is the third quarter only, and then this is the 9 month until the 30th of September for 2020 and 19. So if I see to the bottom, for sure this is reduced, right, as compared to the one previous quarter of 2019. So for sure they are still suffering from the COVID problems. If I see from the 9 months, this is way lower. Major problem was when I see their Q2 statement, right? It's because of that, right? So we see some problem there. So the FF payout ratio is 86.2%. So basically this much they are paying out, right? Which funds they have received. Anything between 70 to 90% is okay. So there is not alarming. So this is within the acceptable range, but if it's closer to 70, it's pretty much good. Let's see from more deeper into it. So this is more deeper into the Q3. So for sure that result, as you can see, decreases because of they need to pay 14.4 million because of the COVID-19. They have some lower lease or cancellation fees, 1 million, 1.7 decrease in general admission cost from reduction to bonus accruals and all, right? So because of that, okay. So okay, what is this adjusted cash flow from operation? This is similar to the free cash flow, basic free cash flow from operations. It's because you just take the free cash flow and adjusted the capital expenditures, right? So that's what it is. So if I see from here, we can easily see for sure. So this one is increase, right? So then, but the overall from 2019 is decrease. Let's focus here. I think the data what I want to highlight here is that one is the dollar term. You can the payout distribution, what they are paying after. Basically, they have some free cash flow. Then after investing in some capital expenditure in their new properties and other investments, right? Which we can see in another slide. You can pause and read it. So overall, the percentage is quite high, right? So you see this is 97.7, and because of that, they don't have their working capital is negative. They don't even have money. So this is the first red flag for me. If the company is paying out that much, pretty much everything company is paying out, right? Almost 100%. Then how the company sustains? Maybe it's a fair amount of chance to maybe they can further cut the dividend, right? Because of that. So let's see, right? From other metrics, how they are doing from their debt size and other side, right? Okay. Yeah, this is another one. So this is the credit rating. This is also very important, and right now this is from S&P and DBRS. This is again from their quarterly statements. So they have issued some this one, this credit rating is on their debt, and the rating is right now is BBB, or this is BBB higher, right? Outlook looks stable. So what does this mean? So anything. So this is on the investment grade, but this is right at the borderline, right? So think that this is the investment or grade, right? or good in the layman term is a good quality, right? Sorry, I am not very on this pen. So this is triple B here, right at the border. Anything below is the junk, is bad. So what does it mean? If something bad happen, right? So if the credit rating drops, so what will happen? Maybe they it has I haven't read their the covenants and all, but basically some condition can be maybe they cannot get the debt, they cannot issue, they may have to if they need to raise the capital, they have to get from high interest rate, so not banks, they don't want to fund them, and there are so many negative impact on that. So they are pretty much at the borderline right now on that one. So but so far on the outlook side, these company, this is a pretty big company, S&P and DBRS, they're thinking their future outlook right now it's stable, right? So they think, okay, they will stay here, they won't drop here. So that's what they have. Does not provide an outlook. Okay. So what they're saying, the S&P doesn't provide the so this is on the credit rating side, right? But on the unsecured debenture, so the company also have issue, might be some unsecured loan in that one. There is no guarantee to pay, so that one doesn't have any. So anyway, that's not too technical level. I don't want to confuse people. So hopefully you'll get the idea. Okay, so this is another. So we are already now. Let's see on to this fund from operations. So let's see from more risk side. So this is the three points I have again here, right? So because we have seen the AFFO and all. So let's see from their letter of credit. So this is very common, right? So just like in the normal person credit line, right? So they have a total of 96.2. Out of this, its outstanding is 16.8, which is higher than it from December 19, right? Which was only, so this means they have a quite of a 68.8 million credit line to use if they want to use. Okay. Usually these companies, they provide some kind of a guarantees to some on their loans and all. So this is the key point to consider. At the quarter ended, this they have no defaulted on any of the primary obligations, right? So far the quarter two, although it's a very bad quarter for them, but it doesn't impact them, right? So whatever they promised, they paid it, and so far there is no red flag there. Okay, so that's very good. The third important then from the perspective which I want to also see is from the what's their excess cash, right? We see they have 0.3. So this is what it's left right now, right? So what they're saying, so this is the again the comparison from the last from third quarter, and this is the full 12 month. So what is this? So this is the cash flow from the operation, right, which they have received. So you can see which is fairly very low as compared to the 2019. And then after reducing the distribution and all, here they're saying, okay, they have something positive left, but it's pretty much half. If you can see, almost half of here, right, of last year, right? But now here, the cash from of operation, excluding the non-cash working capital items, right, which were higher distribution due to the so this one they haven't included that piece. But overall, I think so that's what we have, right? So we can see so far I think they are not as very bad, but pretty much on the borderline what I have to see. If because they're already in AFFO is 97.7%. So what's the future? So what we can try to get from here? So my understanding is, if this second wave of coronavirus, which is hit it right now, and it's further closes the business, it will damage these kind of retail properties, right? So need to be careful. But for sure we know this is not permanent, this is temporary. So by next year, I believe, again, okay, so let's say from the, I have a slide here before we make it. So this is again what, so directly from the horse mouth, right? What's the management is thinking? So this is from their MD&A, right? So they're thinking the COVID-19 adversely affect the global economics, including the credit and capital market, which we have already seen. There is a short-term or long-term capital downturn. For sure, we know understand that. So what is it? It could potentially impact, right, their credit rating, total return for sure, and the dividend yield. So they are saying that they might impact the dividend. So the company might be thinking in terms of that. So maybe they cut the dividend or lower the dividend. You never know. But so far, I haven't seen in the cutting the dividend. But maybe I'm at least right. So let's see from their other debt perspective how they are doing that before we make any conclusion, right? So okay, so their debt to their operating earning basis is quite high right now, right? So which is not good. It should be less than 8, but is 9.18, and in the last year it was little over, but is close to 8. The interest coverage, what is interest coverage? Okay, interest coverage means are they can how much short-term money they are getting if in order to pay their interest on their debt, right? So it should be good if it's over 3 times. So this one is from the short-term side, I think they're saying is good, right? So this is good. So this is good. So this is one flag again. Debt services side, this is also good, right? It's supposed to be 2.25 or greater. They are pretty much good there. Fixed charge, this is the fixed cost perspective. You can think from that. This is should be 1.10 and they are 1. So pretty close. So I'll give them this plus as well. So but the overall debt, if it's compare on this one, it's still lower, right? It's higher. So so that's what they have. So maybe you never know. Right now the share is price, as you can see, it's very low, $14 something, as we can see in the slide. Where is the slide? This one, right? So we can see here the price is low, but maybe if the company cut the dividend, then the price can go down, right? And for at least, or there is a problem in the COVID and all, but for sure, but if the company doesn't cut the dividend, then at least you doesn't matter what's the price on the short term, right? You can still earn the dividend, the monthly premium dividend, which is pretty lucrative, honestly. And this is the next dividend date is 6th of November, right? And the dividend is growth by 50 cents every 5-year average, right? This is what is showing here. So yeah, so pretty much that's it. So that's, hopefully you like this video, and please give a thumbs up to this video and subscribe to the channel. And thank you again for asking to make this video on this one. I don't own any of this share right now, and yeah, so let me know, do you want to buy, do you want to little bit hold? I believe, but from the next year onward, this the price should go up around maybe $17-18 when I did some little math, or maybe if the best scenario, it can go up by totally from where it comes. That's really a bonus, right? Which is 27 something, go back up. Okay, so yeah, don't forget to subscribe as well, like, and also comment, right? What other your favorite stock? It's also good to see and why you have invested that. If you can put, that's great. But don't forget to please smash that like button and subscribe to this video. Thanks for watching, and bye for now.